Mike Muller, head of Vitol Asia. Mike, just reflecting on the first quarter, your sort of surprises. When did we turn a corner? Have we broken out into a new sort of trading range? Let's say your thoughts on reflection of Q1.
Yes, I mean, I think what we witnessed in the last few weeks is a realization by financial participants in our markets that oil was something they wanted to be longer than they were. We've spent much of the last 6, 12 months having most sort of macro funds and non-physical players in our market sitting on the sidelines, deciding to be risk off with a couple of entries and exits around geopolitical situations. But there was a big macro inflow, as we refer to it, in the last 3 weeks. Now, on the historical scale, it's still nothing. We still have relatively low participation in energy markets, but there's a realization that energy commodities correlate extremely well with inflation. And if there's renewed concern of inflation, then this is a hedge people seem to want. By the same token, of course, you get people who've been trading the range. They've been basically buying mid 70s, low 70s, high 70s, and they've been selling 80s, high 80s. And whenever the markets break into a new trading range, and that psychological $90 barrel is the number, I guess, then a bunch of people stop out. So you'll have a little bit of that as well, where people who were short decided that they needed to trim their shorts or indeed cover. So the backdrop to that, of course, was then that OPEC Plus decided to do what was largely expected, I guess, and continue to roll over their current state of affairs. And as such, we have a market that is not necessarily tight in the prompt, but given most people's projections for later in the year, most people, most consultants, most experts, most advisors are calling for stock draws later in the year, and that's giving a firm underpinning to the fundamental picture as well. All the while, of course, we must remind ourselves that OPEC and Saudi in particular have the option to change that picture by gradually letting volumes back into the market from their spare capacity, should markets get even stronger and that not be to their liking.
Just looking at, again, the sort of more sort of focus in on the breakout moment, mid-March, if you like, when we sort of seem to come out of the tight high 70, low 80 and move now into, above 90, but progressively in that direction over a few weeks. It seemed a number of things happened at the same time. Again, as mentioned, inflation concerns came back in and the likelihood of rate cuts diminished. We also had the OPEC Plus announce the rollover of their cuts into the second quarter, and the geopolitical heat turned up a bit. I mean, as you reflect on those different influences, do you think any one stands above the other as a driver, and then where this could go? But in terms of the breakout, does any one of those stand more out for you as the trigger for the breakout?
No, I think the fundamental physical changes in the oil markets have taken a sort of second-tier backseat to the money flows. I think financial markets have convinced themselves this one is a buy. Yes, you've had some disappointment or concern. The blockages in the Red Sea, thanks to the Houthi attacks, resulted in an almighty great big stock build of product, in particular on the water. And it was perceived that that would weigh on markets in some ways. And whilst physical markets at the front end aren't exactly tight, they're perhaps less awash than people expected. People keep edging up their demand predictions year on year for 2024. Places like India are growing at rates that were faster than expected. As Christoph said, China is throwing their policy machine at growth as well, so reassuring people there also. The industrial manufacturing indices around the planet, but China in particular, have now been positive. The key index there has been above the critical 50 mark for, I think, 4 or 5 months running now. And as such, people are looking for problems on the supply side. And whilst there have been no major stories, we've had Sudan out, of course, but that's not a huge one. That's several cargoes a month rather than a huge program. But we have no Kurdish oil back yet in measures. That's failed to come through Turkey so far. No resolution there. And as Christoph mentioned, the attacks on the Russian refineries have taken away some of that product supply and replaced it with crude supply up to a limit where you start asking yourself, is Russia at crude export maximum through the Baltic ports? So whilst we see these spectacular footages of drones hitting refining installations and big flashes of explosions, the capacity for the refining business to repair its damaged assets it always amazes me. But at one point, I think it does look as if we had the best part of a million barrels a day of refining capacity out in China because of those multiple hits. That last time I came on this program, I said I was very surprised by the ability of Ukrainians to strike that deep into Russian territory. But yes, air defenses haven't been doing their thing. So the culmination of everything there has just given people the reassurance that it's a tighter picture. But the biggest view, I guess, is the second half of the year, as I mentioned before. We're projecting refining demand in terms of the need for the world to run its refining system to be a lot higher than in 2023. For the second half of this year, maybe 2 million barrels a day more. And global demand growth is projected by most to be 1.7, 1.8, even a bit more than that, million barrels per day higher than last year. So we're not in any way petering out towards peak oil here. We're at one of the fastest year-on-year growth rates we've ever seen in the last 20 years of history.
Mike, looking forward, obviously, as mentioned, OPEC Plus rolled its cuts, its 2024 cuts and all cuts. Obviously, the main bulk of them are rolled right to the end of the year, but the 2.2 is till the end of the second quarter. Your thoughts now, and given the outlook and the sort of growing positive economic frame that the OPEC Plus group could look to start unwinding cuts in the second half. They do have a big meeting in June. How serious do you think they will consider that option?
Well, they convened a bunch of analysts and consultants in Vienna 3 weeks ago or 2 weeks ago, and their preoccupation there, from what I'm told, seems to have been financial flows in and out of money markets. They observe $1 per barrel backward Brent spreads, and everyone likes that because investors go long the front month and they roll $1 into their pocket every month. It's called the positive roll yield. That's a state of affairs that is a nice position for OPEC, right? It gives a certain degree of comfort that financial players will be in that space, and more will flow in and be attracted to a roll yield that, if you do get $12 per barrel on $90, you can do the maths. That's 13-point-something% return per year. Extremely attractive, right? So I think that's what's preoccupying people for the most part. There is, I don't think it is baked into most people's fundamental projections that OPEC Plus and Saudi in particular will continue leaving oil off the market for the balance of the year. I think there is a view that there'll be some pragmatism if $90 becomes $100 Brent, and there'll be a bit more oil released into the market. That seems to be in people's minds, at least from what I've been asking traders around me in my company. But
if you take the flip side of that, Mike, and you have a deficit in supply, and of course you draw down on inventory. Inventories are already low in relative terms. It all, I suppose the further drawdown of inventories from a market management point of view. I mean, OPEC Plus has done its job here. Doesn't really need more drawdown, does it? Your thoughts on that? The continuous supply deficit will continue to draw down already low levels of stock.
Well, there's inventories and there's inventories. So I mentioned a few minutes ago that on the water inventories for refined products are pretty high, and they haven't really come off all that hard. And that's largely a function of rerouting of cargoes. And we already have a structural rerouting because of Russian flows and sanctioned barrels subject to price cap needing to go to Asia when they'd normally find homes in Europe and so forth. So that's just taken another level up. But that's not the whole picture, of course. There are areas where inventories have been coming down. I mean, Chinese onshore inventories, to the extent that they're visible to us, are still healthy. But it's not the case everywhere. You wouldn't have $1 per barrel crude Brent spreads in backwardation if you had ample supply of oil at the very front of the market, right?
Mike, on that point, did Venezuela's 6 months of openness move the dial at all? Has it changed flows? Has it done anything of note? And so if it was to go away again, it wouldn't be that big a deal. Your thoughts on that?
Not materially. What changes is the parties that handle the oil. Markets have shown us through the period of sanctions that those exports will flow. What's not happening, of course, is investment. But should General License 44 lapse in, less than 10 days from now, then Venezuela will likely revert to exporting its crudes via channels that will take them to markets that will flaunt the sanctions. But there is a view that this candidate that's been put forward for the opposition in Caracas might just provide Washington with the pretext not to allow GL 44 to lapse, but I think it requires an active decision of renewal. So we still wait to see. And of course, the entire system and the banks in particular are going to be very, very hesitant to support exports running close to that April 16th deadline. So it's going to be one to watch.
On the other side of that sort of, who flips and the various sort of dark fleets, as it's called, on the Russian trade, it seems the American threats and sanctions have scared a lot of shippers out of that market. Has that changed the fundamentals of that flow in any way? Has it created impact for other areas of the market?
Short answer, Sean, not really. Obviously, it's very hard to see all of it.
Yeah.
But there has been, in the side of the world where I'm sitting here, there has been a steady state, I guess, and a gradual acceptance that certain behaviors that are required in order to make Russian oil look less Russian, in other words, for it to be blended or processed or staged and then reloaded somewhere, those people happy to take these Russian products rather than crude, because crude is rather simple. It's China, India, and in the Eastern Hemisphere, have been reasonably comfortable taking it directly. So there's actually been somewhat less interest in storage and floating storage and very old ships.
I wanted to get your comments on what's another sort of story of note that struck me in Q1, particularly in CERAWeek, but also resonated before and after, and that is the IOCs sort of moving away from transition policies or narratives, or speaking out more aggressively against the transition, and also where it might intersect with, the likes of major trading hubs like Fujairah and others who have to consider about their, low carbon bunkers infrastructure and plans of the future, and refinery compositions and so forth. Does this all add up to something new in your opinion, this new direction, or is it just more stating the facts of what was already in place? Your thoughts on these first quarter comments?
Yeah, it's a tough case of striking the right balance, because the European majors, still being outperformed by the US majors, have appeared to pivot somewhat towards upstream and upstream gas in particular, and power being a more acceptable space to invest. But it would appear that traditional downstream oil is still pretty unloved, and there are some clear steps afoot from all the majors, the Americans included, to rationalize and essentially look to shed assets that are high carbon, high emission, and are never going to give them a fantastic return. There's more upside in exploring for deep water oil or for LNG scale natural gas than there is in building a storage facility or building or keeping refineries. So in that sense, I think you'll continue to see the majors very unlikely to enter into anything that gives them more refining exposure. On the contrary, it seems that that's something they're increasingly willing to exit. But I think the major refocus for the European majors, be it Mr. Sawan, Mr. Puyene, or Mr. Auchincloss, is upstream is okay. And the profits they're making that are beyond expectations a few years back are largely going there.